Welcome to Life Insurance 101, created and offered for your use by Diversified Brokerage Services Incorporated. This is designed to be a high-level introduction to life insurance. We'll cover three areas, starting with why people buy life insurance and the basic questions that need to be assessed in determining a client's need for life insurance. There we'll move on to a discussion of the types of insurance available in the market, and finally, we will provide an overview of the underwriting process. Life insurance is a risk management tool. Its primary purpose is to protect the people and the organizations from the losses incurred at the death of the individual, but it does much more. While not a primary reason to buy life insurance, permanent life insurance can build cash value that grows on a tax-deferred basis. It can be accessed by the owner to help supplement income potentially on a tax-favored basis. Finally, life insurance is the only financial product that can produce a known quantity of money, generally on an income tax-free basis, at the moment of death, exactly when it's needed most. So, where do you start when you first approach a client about the purchase of life insurance? The starting point is an assessment of whether there is an insurance need. If you get a positive answer to the question, will someone or some entity suffer financially by the death of your client? There may be a need for life insurance. The question then to move to is, how much life insurance does the client need? The answer to this question is usually based on a financial needs analysis calculation that's generated from data gathered from the fact finder. Finally, an appropriate product or products need to be selected. One of the key questions is, how long will your client need to be covered? That brings us to the next topic, a discussion of the products available in today's market. Generally, life insurance is divided into two broad categories: insurance designed to last a short period of time, called term insurance, and insurance which can last a person's entire life, usually referred to as permanent insurance. There are no hard and fast rules regarding the type of insurance policy someone should buy. However, typically, the type of life insurance someone will purchase is based on how long they're going to need the coverage. Traditionally, short duration needs, such as covering financial needs while children are growing up, or to pay off a mortgage if the breadwinner dies, they've been addressed by term life insurance. For longer duration needs, term insurance doesn't work very well. A product meant to provide coverage for a lifetime may be more appropriate. These include whole life insurance, variable life insurance, and universal life insurance. Term insurance is the basis of all life insurance coverage. It's pure insurance, much like your auto or home insurance. You pay your premium. If there's a claim, it's paid. If there's no claim, the carrier keeps the premium. Simply stated, term insurance provides a death benefit in exchange for a premium payment. It generally does not build policy value, though some policies sold offer return of premium benefits or cash value riders. Most term life insurance sold today features a premium that's level for a certain number of years. For example, 10, 15, 20, 25, or 30 years. These premiums are usually guaranteed not to increase during the period selected. After the level premium period, it may be possible to continue the policy, but premiums increase substantially. Term does give you flexibility in locking in your insurability for potential conversion opportunities. Because of the basic coverage of term, the premiums are usually the least expensive of all life products. Whole life is the classic form of permanent coverage. Generally, whole life features guaranteed premiums, cash values, and death benefits. Many whole life policies have a mechanism where cash value growth is enhanced by excess earnings or investment growth beyond the basic guarantees. In most policies, The premium remains level throughout the life of the policy, although some policies provide for paying higher premiums for a shorter premium paying length, for example to age 65, with no further premiums due from that point on. Whole life policies usually require continuing premium payments for the life of the policy. Policy values are available for loans, which will reduce the death benefit available. Some whole life policies permit withdrawals from cash surrender value. Some whole life insurance policies promise that the cash surrender value will equal the death benefit by a specified age. UL was introduced in the late 1970s as a more flexible alternative to whole life insurance policies. These policies were unique because they offered policy owners significant flexibility in premium payments and death benefit options. In addition, policy values in the policy could earn current interest rates, backed by a base guaranteed rate. This contrasted with whole life insurance policies that offered a guaranteed death benefit with guaranteed policy value for a guaranteed premium and little or no flexibility beyond on how to apply any credited dividends or excess interest. Additionally, UL policies are very transparent. The fees and charges supporting the policy are all fully disclosed in the contract. Certain charges, such as cost of insurance charges, are not guaranteed. Although subject to change, cost of insurance charges will not exceed guaranteed policy maximums. While universal life insurance offers a flexible premium structure, the amount of premium paid impacts the viability of the policy. In fact, policy value exists only if the amount of premium paid exceeds the fees and charges that are necessary to support the policy. If there is a policy value, it will be credited with interest. The amount of interest credited is set by the insurance carrier, but is guaranteed not to drop below a certain level stated in the policy. When universal life was first introduced, there was just one form. Today, there are many types of UL policies, which can generally be divided into two categories: fixed UL and indexed UL. With a fixed UL policy, the policy value is credited with interest that is set by the insurance carrier. In contrast, with an indexed UL policy, the interest crediting is based on the performance of a major market indices such as the S&P 500. When there are multiple index options, the policy owner chooses from the available options. With an indexed UL policy, the policy owner can participate in the upside of the market, but has a guaranteed downside protection against declines in the value of the applicable index. In addition to a difference in how interest is credited, a UL policy design can either be on providing a no-lapse death benefit guarantee or cash value accumulation. Cash accumulation UL policies offer the opportunity to grow cash values based on the carrier's investment or in an indexed model. These can be very effective in leveraging the tax advantages life insurance provides. They also provide premium flexibility, as the client can reduce or stop premium payments if the cash values are sufficient. With a cash accumulation UL policy, there must be adequate cash values for the policies to continue. In contrast with variable life, VL, or variable universal life, VUL, insurance policies, the premiums not needed to support the policies are invested in sub-accounts. These are special types of mutual funds designed for use in variable life and annuity products. The policy owner selects the asset allocation into these sub-accounts. Just like regular mutual funds, these investment vehicles carry a similar risk that the value may go down rather than up. This passes more of the risk of the policy performance from the insurance company to the policy owner. If the investments don't perform well, the policy owner may have to increase premiums in order to keep the policy in force. Like universal life, when variable life insurance was first introduced, if the product did not perform as illustrated, it was possible that the policy could lapse. Stated differently, it was not possible to guarantee a variable policy against lapse. However, today some carriers provide a variable policy which is guaranteed not to lapse, regardless of how the market performs. Finally, in some situations, primarily estate planning, it is desirable to have the death benefit paid at the death of the second of two people. Survivorship life insurance was created for this purpose. Because they insure two lives but pay only one death benefit at the second death, these policies are also known as second-to-die life insurance policies. Second-to-die policies can be universal life, either fixed, indexed, or variable, or whole life insurance. Once your client has decided on the amount and type of insurance, the next step is to determine whether an insurance carrier is willing to accept the risk. Specifically, a client who's interested in life insurance will need to go through an application process. This is the period during which an underwriter at the insurance carrier will evaluate risk. Company guidelines are used to evaluate a proposed insured and determine the premium rate class to be applied based on the health of the insured. In addition to evaluating the potential risk of death, the underwriter also has to examine the case from a financial underwriting perspective to determine if the amount of the insurance being applied for is appropriate and consistent with the risk of loss. Call us with a case you're working on and let us help you. Please take a moment to review this information from our compliance department. And thanks for your time and good selling.